So let's look at an example of last week. So this is JPMorgan. So JPMorgan beat the estimate, so beat the earnings, but there's still kind of like some concern about the outcome for the future. This was on July 15. So let's look at the dashboard, and then we're going to go into details. There's going to be some interesting earnings coming tomorrow, so we're going to look at the data as well. So here what we have is our Q score. Our Q score is telling us that, so first we are in a positive gamma environment. You see that on the left-hand side. Our option and momentum score is very high. So this is what our quant models is telling you. We are in a bullish option cycle and we are in a bullish momentum. But again, pay attention because we see an increase in volatility. Of course, we are coming into earnings, so the volatility around earnings is much higher. We are also in a very, very positive seasonality, right? So this is what kind of like the model is telling us. So very strong option positioning, very strong momentum, strong seasonality, but again, pay attention to volatility. The option matrix is telling us that on July 18th, 36% of gamma was expiring. So again, we are at July 15th, that's the day of the earnings. July 18th, we see about 36% of gamma expiring, but we are overall in a positive gamma environment, which is obviously good for the volatility of the asset. If we look at the skew is telling us kind of like the sentiment in the market. So the skew is looking at out of the money puts versus out of the money calls. If we are in a call bias environment, that means the investors are willing to pay a higher volatility for the premium on the calls versus the put at the same moneyness. So again, this can be used as a sentiment indicator for your trading. So here we were also in a call bias environment. And then next, we can look at our swing model. So the swing model is telling us our lower and upper level for the next 5 days. So this was the data that you would have got on July 15th, the day of the earnings. We have our lower band at 278.83, and we have a risk trigger at 298.57. The model success rate over the past 118 days was 82%. So again, that means that in simplicity, in 82% of the days, the price of the asset, so in this case, JPMorgan, 5 days in the future closed above the lower band, closed above the lower band. So in this case, we're looking to stay above 278.83. So how can you then use this information? Well, you can use in different ways. And here we can see basically how you can then plan your swing trading and your kind of trade using the level. So here we have our lower band, we have a risk trigger at the top, and again, this is the range that you are looking for the next 5 days. If we look at the price from today, let's see where JPMorgan is at. We are at 293.56, so we are kind of like going towards the risk trigger level that we see on the chart. All right. Next one, Netflix, right? So Netflix is, again, they beat earnings. The growth was 16% in the second quarter, but there was some concern during the earnings, and this was from July 17th, right? So again, let's look at what the data is telling us. This is the quant model. So we see, again, here, we are in a positive gamma environment, but we see that the option market is actually in a neutral position, right? So we're still in a bullish regime, but the option score is not 4 or 5, it's 3. So the option market is maybe concerned about the fact that Netflix is at all-time high, concerned about the future growth, and they are reacting in the same way. Momentum is neutral, so we don't see a bullish momentum on Netflix currently. We don't have seasonality, and also the volatility is kind of neutral as well, right? So this is what the models are telling us. But let's look at the matrix. So this is what the matrix that you see on the day of the earnings. And what is very interesting is that for the expiration of July 18th, which was the weekly expiration from last week, at the beginning of the day, we saw an increase in negative gamma by about 2 million and you see this from the column JEX change. So that means to me that maybe a lot of participants are basically worried about the earnings, and maybe they're scared that Netflix is not going to do so well, so they are like acting and they're using the option market to do that. If we look at the skew, we're still in a call bias environment, but you can see how the skew kind of is going towards the neutral line. So we're going towards the orange line there, but we are still in a call bias environment, right? And then finally, we want to look at the swing model. So again, we are still in a bullish bias coming from the swing model. Our lower levels to monitor is 1,184 for the next 5 days, and our upper level is 1,315. Again, look at the back testing at the top. The models is telling you that the success rate over the past 118 days is about 86%. So now, if we look at the levels, what we see is that Netflix, the day after the earnings, obviously opened much lower. You see that in the chart. We have a lower band there, and then we have a risk trigger. So if we look at the price, now let me open a Netflix chart. The price now is 1,203. So Netflix is kind of approaching our lower band, right? So again, we are a few 20, 30 points or $20, $30 from that lower band. So that lower band can be your support area, can be your stop loss area, can be used in many, many different ways. But this is important because we are using data to potentially